Welcome. Today is Thursday, February 9th. I'm Jeff Hughes, Chief Investment Officer, JWH Investment Partners, and the founder of Alpha Insights. And this is your Daily 5. Today, first thing I want to do is just remind everybody that our newsletter came out on Saturday, February 4th. Just a reminder, we publish a free investment newsletter. It's free to subscribe. It's delivered directly into your email box, usually the first Saturday of each month. And it's affectionately titled Huge Insights, the Big Picture. And what we talk about in the newsletter is really the key macro factors that we think are affecting the economy and the markets. And we also offer kind of an upgraded opportunity as well for those who want a little bit more. We often get inquiries from people telling us that they really like our strategic view, but they want to know how to implement a strategy. And so, what actionable ideas could we provide them? And so what we've done is we've created this upgrade to paid, this paid optional service. It's $10 a month. It allows you to receive our top actionable trade idea. Every Wednesday, we publish a note called Alpha Insights, the Idea Generator Lab, and this is an institutional publication. And again, every Wednesday we detail our top actionable trade idea. We've also actually included some additional perks for paid subscribers now. We're putting out some periodic special edition research reports and some regular video content as well. So it's a real value add, and I think you probably enjoy being part of the service, so it's worth a try. With that said, let me just jump into chart number 1 today and tell you what's on our mind with respect to the markets. Now, the question that I think is really germane today is whether or not rates and the US dollar have bottomed. And if you'll recall last September, October, as the stock market was, putting in its process of a bottom, it was making lows in late September and again in mid-October. And as this was going on, we actually saw the 10-year Treasury yield topping and the US dollar topping simultaneously. And that reciprocal, that topping process that was initiated in late September with a high in the US dollar for this rally and an interim high in the 10-year Treasury yield. And as yields made their cycle highs in mid-October, the US dollar actually made a lower high. That negative divergence in those two separate issues, contra to the S&P 500, actually sent us a pretty important signal. And I got to be honest, I missed it. I heard it, I was aware of it, I just didn't believe it at the time. And so, we didn't think that rates would fall to the extent that they did. We didn't think the dollar would fall to the extent that it did. And so we were wrong about that. And, the rally that ensued was a fairly significant rally. It came in 2 specific up waves, one into the December 13th high, and then one from the December 22nd low into so far the February 2nd high. But what we think is possibly happening is that on February 1st, the US dollar made its low for the decline, and the 10-year Treasury yield bottomed the next day. And just as that was occurring, the S&P 500 put in its rally high to date. And so the question that we're really asking here is, this inverse relationship between stocks and bonds now appears to be back in play, and it's been augmented by the US dollar. And if the lows in the dollar and the 10-year Treasury yield are to hold, the question is, could that mark the end of this stock market rally? And one of the things that I think will determine that is a very important piece of economic data that's slated for release on Valentine's Day. And that's the January CPI report. So we had thought about labeling this chart My Bloody Valentine, because I think it's all going to hinge on whether or not that CPI report comes in as expected, cooler than expected, or hotter than expected. So stay tuned. We'll find out next Tuesday on that. Chart number 2, another question that's kind of rambling around a lot of people's minds right now is, what's going on with sentiment? Is sentiment still bearish? I mean, all of the survey data, back in from October through really the end of the year. I mean, recall that the NASDAQ 100 made its closing low for the bear market decline on December 28th. So, it was the laggard in terms of the decline. But, we continue to see a lot of fear in the markets based on the survey data. And what we're seeing now is a sharp reversal in that. The CNN Fear Greed Index, which is a compilation of 7 different intermediate term indicators that measure some sort of aspect of stock market behavior. They're, market momentum, stock price strength, stock price breadth, the put call ratio, junk bond demand, market volatility, and safe haven demand. These are the 7 categories, and the index tracks how much these individual indicators actually deviate from their averages compared to how much they normally diverge. And so, the index gives an indicator that's equally weighted across all 7 of these, and the score ranges from 0 to 100, with 100 representing maximum greediness and 0 signaling maximum fear. Well, I guess the point of this chart is that the index posted a new 52-week high last Friday. It entered into the extreme greed zone for the first time in over a year with a weekly closing reading of 76%. Now, you may recall that back in June, we got down, actually it was back in May, I believe, we got down to almost 0, where the fear was so extreme, had to do with the war in Ukraine, et cetera. We got, very close to that again in late September, mid-October. And then, in December, we pulled back, but didn't quite get down into the fear zone. It was more of a neutral reading. But here we are at extreme greed. So, I think the jury's still out right on the market, but there's no question that the animal spirits of investors have been reawakened by this price action. Let's look at chart number 3. Chart number 3 takes a look at another investor sentiment gauge that might be poised to come back into play very, very soon. And that's the volatility index, the VIX. And what we've done is we've juxtaposed the VIX with the VVIX, the volatility of volatility index, to give you some sort of a reference point of how volatility is trading itself. The VIX actually just posted its 52-week low on February 1st. The day before the stock market topped, basically so far for this rally. And the VVIX, which is the volatility of volatility, that actually made its 52-week low back on January 6th, almost a month earlier. And so the two have been diverging pretty aggressively since. And that positive divergence in the VIX, in the VVIX relative to the VIX, actually has some historical significance. These positive divergences between the two series have often preceded sharp trend changes in the VIX, and many times that's resulted in volatility spikes. And so, an initial confirmation signal that the trend in the VIX is reversing is typically generated when the VIX posts a daily close above its 21-day moving average. Well, lo and behold, yesterday, the VVIX gapped higher, and the VIX closed above its 21-day moving average. And so, as such, based on the historic relationship between these two, we would expect volatility to turn up significantly, potentially spiking in the days and weeks immediately ahead. And, honestly, the last several times we've seen volatility spikes over the last year, it's carried the index up to around 34, 35%. But, I would not be surprised to see it exceed that level. We haven't printed a volatility spike above 40% in over 2 years now. That is our target right now. We think we could see a volatility spike that exceeds 40% this time around. So again, stay tuned on that as well. Let's look at chart number 4. This is probably the most important chart of this deck, and it is our preferred Elliott wave count. Our preferred Elliott wave count assumes that the January top, last January in the S&P 500 index, marked the high of cycle wave 5 of super cycle wave 3, a very long-term advance that began in 1932. And if we're right about that, we're in the early stages of super cycle wave 4 down, which is a corrective waveform. But, looking just at the primary and cycle wave sort of movements in the market itself, we've counted the 5-wave decline off that January 4th, 2022 high into the June 17th low as primary wave 1 down of a larger degree motive wave, which we believe has the potential to carry the index down into the S&P 2250 range before it bottoms. And under this rubric, we've assumed that the counter trend advance into the August 16th high marked the end of primary wave 2, and that primary wave 3 down has been subdividing an intermediate degree of trend, setting up the market for what is known as a third of a third wave decline. And you can see that on the left-hand side in our cap weight S&P 500 count. Now, that being said, we've also analyzed the equal weight index of the S&P 500, and we actually find a different count there. We find a leading diagonal that appears to have bottomed with the market in mid-October and may actually be a more compelling account. Now, let me be honest, this count is not perfect. The fifth wave is truncated, and that truncated fifth wave actually raises some doubts. Usually, Elliott's rules require that the fifth wave in an expanded version of a leading diagonal actually exceed the length of wave 3. It has not done that. It is truncated. That being said, Elliott did not know about the equal weight index when he wrote those rules because it didn't exist. It's only 20 years old. And so it's very likely that it's just the index configuration that's making that show up as kind of a break in the rules. But we'll just kind of think about that in general as another possibility that might exist. Both of these counts, have seen their latest counter trend advance retrace approximately 78.6% of the prior motive wave. In the case of our cap weight preferred count, we've actually exceeded that 786 retracement and rallied right into the 100-week moving average. But the point is, if it turns out that the leading diagonal pattern is also operative in the cap weight index, then it's possible that we could see the market, carry slightly above that August high, just the way it did in the equal weight index before primary wave 2 were to top. And, that is one possibility that we're kind of considering as an alternate. It would be our second alternate now, but we wanted to bring it to the fore here for people just to kind of get a sense of, how we're thinking about the market, what could potentially occur. Right now, we're really focused on this preferred count on the left-hand side, our cap weight count. As long as we don't exceed that 100-week moving average, and more importantly, the primary wave 2 high on August 16th, then I think we are in the midst of a third wave decline that may have started as recently as February 2nd. So with that, let's take a look at the short-term view on the market. This is at intermediate degree of trend, and we're really looking at a 4-hour intraday range chart at all the price action in the S&P cap weighted index since August 16th. And you can see that the decline into the October 13th low was a clear 5-wave decline, an impulse wave that bottomed, and we're counting that as intermediate wave 1, and that the rally that has taken place since has occurred in 3 waves. And we're marking that out as a double zigzag, WXY. And we think the Y leg of that double zigzag probably topped last week at the February 2nd high, I think on Thursday. And that was S&P 4195. It fell just short of an unfilled chart gap at 4228. And the Fibonacci 88.6% retracement. 88.6% is the square root of 78.6%. So we got very close there. So there is the potential that we could maybe the market wants to fill that gap. We're pretty darn close, and it doesn't have to be filled. There's no requirement that a gap gets filled. But we're thinking at this point that the decline into the recent low was probably minute wave 1 down, and we may have already topped at minute wave 2. And so as soon as we take out that minute wave 1 low, we'll know that, the pattern's complete. And, if in fact we were to see a sustained rally back above the February 2nd high, then that would suggest that, our alternate leading diagonal count may actually be operative. So with that, let's keep an eye on the market. Now you know what we're thinking about. If you'd like to follow up with us, you can reach us at our website, jwhinvestment.com, or follow us on Twitter at alpha_insights, or check out our website, hugeinsights.substack.com. As always, thanks very much for watching and good luck trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.